Ever wondered how Warren Buffett picked his winning stocks? It's not just about gut feeling, but he used something called fundamental analysis. Therefore, if you are buying a house, you do not just look at the paint job, you check the foundation, the plumbing, everything. That is what fundamental analysis does for companies. Therefore, we are going to learn how to look beyond the price tag and uncover the true value of a business. In this video, we are going to teach you how to evaluate the intrinsic value of an asset, typically a stock, by examining related economic, financial, and qualitative factors. The goal of fundamental analysis is to identify stocks that are undervalued or overvalued by comparing their intrinsic value with the current market price. This technique helps investors make informed decisions based on long-term growth prospects rather than short-term market fluctuations. This is Finance and Investment Hub. Simplifying finance and investments for everyday success. Fundamental analysis is a method of evaluating the intrinsic value of an asset by examining factors that could influence its price in the future. Therefore, the objective of fundamental analysis is to identify undervalued or overvalued assets for investment or trading purposes. It examines macroeconomic factors, financial statements, industry trends, and other factors to determine the true value of an asset. Macroeconomic analysis. Think of it like you are trying to build a skyscraper. You must have a solid foundation, or the whole thing comes crashing down. Macroeconomics is that foundation for the financial assets market. What is macroeconomics? Basically, it is the big picture stuff. Things like interest rates, inflation, unemployment, and even global events. These factors do not just affect the economy as a whole, they directly impact individual companies and their stock prices. Let us break it down to some of the key macroeconomic factors. Interest rates. When the central bank raises interest rates, it can slow down the economy, which can impact consumer spending and, you guessed it, company profits. Inflation. If prices are rising too fast, it eats into consumer purchasing power, and companies might struggle to keep up with costs. Unemployment. High unemployment means less consumer spending, which can hurt businesses. Fiscal policy. It is how governments use spending and taxation to influence the economy. Tax cuts can boost consumer spending and stimulate economic growth. Government spending on infrastructure or social programs can create jobs and increase demand. These policies can directly impact a company's profitability. For example, if the government increases taxes on a particular industry, it can squeeze profit margins. Global conditions. The world is interconnected, and events in one part of the globe can have ripple effects elsewhere. Global trade, tariffs, trade wars, and supply chain disruptions can impact businesses that rely on international trade. Geopolitical events, wars, political instability, and natural disasters can create uncertainty and disrupt markets. Currency fluctuations. Changes in exchange rates can affect the profitability of multinational company. But do not worry, understanding these factors is not rocket science. By keeping an eye on the news and following key economic indicators, you can get a better sense of the overall economic climate and how it might affect your investments. Industry analysis. Why do I need to know about the whole industry when you are only interested in one company? Think of it like this. You are about to open a restaurant. Would you not want to know if the area is already saturated with eateries, or if there is a growing demand for a specific type of cuisine? That is exactly what industry analysis helps us do. We shall be looking at three key aspects: industry life cycle, competitive landscape, industry trends. Industry life cycle. Understanding where an industry sits in its life cycle can help you identify potential opportunities and risks. Early stage, growth. This is the exciting phase. Think about the early days of the internet. High growth, lots of innovation, but also high risk. Mature stage. The industry has stabilized. Growth may slow down, but profits are more predictable. Decline stage. Demand is falling, and companies may start to struggle. Competition. We can use Porter's 5 forces to analyze the competitive landscape. Threat of new entrants. How easy is it for new companies to enter the market? Bargaining power of buyers. How much power do customers have to negotiate prices? Bargaining power of suppliers. How much control do suppliers have over input costs? Threat of substitutes. Are there any alternative products or services available? Competitive rivalry. How intense is the competition among existing players? By analyzing these forces, we can get a better understanding of a company's competitive position and its ability to generate profits. Industry trends. Technology is constantly evolving, and consumer preferences are always changing. Technological advancements. How are new technologies impacting the industry? Regulatory changes. Are there any new regulations that could affect the industry? Consumer behavior. How are consumer preferences changing? By staying informed about industry trends, you can identify companies that are well-positioned to capitalize on new opportunities. Company analysis. If you are buying a used car, you do not just look at the exterior. You want to pop the hood, check the engine, and see if it's been well maintained. That's exactly what we do with company analysis. We shall be looking at 4 key areas: financial statements, financial ratios, competitive advantage, management quality. Financial statements. By analyzing these statements, we can get a good understanding of the company's financial health and performance. Income statement. This shows the company's revenues, expenses, and profits over a period. Balance sheet. This gives us a snapshot of the company's assets, liabilities, and equity at a specific point in time. Cash flow statement. This shows how much cash is flowing into and out of the business. Financial ratios. These are formulas that help us compare different companies and identify areas of strength and weakness. Profitability ratios measure how efficiently a company generates profits. Liquidity ratios measure a company's ability to meet short-term obligations. Solvency ratios measure a company's ability to meet long-term debt obligations. Efficiency ratios measure how effectively a company utilizes its assets. By calculating and analyzing these ratios, we can gain valuable insights into the company's financial performance. Company's competitive advantage. What makes it stand out from the crowd? Strong brand. Think of companies like Apple or Coca-Cola. Their brand loyalty is incredibly valuable. Innovative technology. Companies that develop cutting-edge products and services often have a significant competitive advantage. Cost advantage. Companies that can produce goods or services at a lower cost than their competitors have a major advantage. Management team. Finally, we need to assess the quality of the management team. Experience. Do they have a proven track record of success? Leadership skills. Are they effective communicators and decision makers? Integrity. Do they act ethically and in the best interests of shareholders? Valuation methods and fundamental analysis. Valuation methods. How do you determine if a stock is truly worth buying? That's where valuation methods come in. Think of it like buying a house. You've checked out the neighborhood, inspected the house itself, but how do you know if the asking price is fair? That's where you use different valuation methods to estimate the true value of the property. We'll be looking at 4 key methods: discounted cash flow, price to earnings ratio, price to book ratio, dividend discount model. Let's break down the DCF. It's a bit more complex, but it's incredibly powerful. Step 1. Forecast the company's future cash flows. Step 2. Determine the appropriate discount rate. Step 3. Discount those future cash flows back to their present value. The DCF gives us a very precise valuation, but it relies heavily on assumptions about future cash flows, which can be uncertain. This is a much simpler and more widely used metric. High PE ratio suggests investors expect high growth in the future. Low PE ratio may indicate that the stock is undervalued. However, it's important to compare a company's PE ratio to its industry peers and historical averages. The PB ratio is often used for value stocks, such as banks and insurance companies. High PB ratio suggests the company's assets are overvalued. Low PB ratio may indicate that the stock is undervalued. Finally, the DDM is used for companies with a history of paying dividends. It assumes that the value of a stock is derived from the future dividends it will pay. The higher the expected dividend growth rate, the higher the stock's value. In summary, fundamental analysis offers a comprehensive framework for understanding the true value of a company, helping investors align their strategies with the underlying economic realities and business